welcome to the exchange, which is the blog's first APEC specific webinar series. So there are 4 episodes, and we are starting with the episode of DeFi, which really exciting. Is basically what everybody's talking about. And what the blog is really trying to do here with this webinar series is to bridge the East and West, right, with our networks in both regions to trying to fill the information gaps. And so with our first webinars, I'm just really excited that we got to invite basically all the industry leaders in DeFi that are trying to do the similar things as the blog, trying to bridge the gap between East and West. And so to kickstart, we have here Hasib Qureshi from Dragonfly Capital, and also from Dragonfly Capital, Mia Deng Gege. And from DForce, we have Yang Dao. And from MakerDAO, we have Pen Chao and also Mabel Zhang from Multicoin Capital. So I think we can start with you guys do a self-introductions and how you guys are related to DeFi and the Ethereum ecosystem for the audience that are less familiar with you guys. So why don't we start with Chao?
Sure. My name is Chao. I'm the China lead at MakerDAO. I joined Maker at 2017 when there was no concept at like DeFi. So what I'm trying to do is just actually just bring the product from the West to the East users, and it has been going very well.
Great. Hasib, do you want to take over?
Yeah, so I am Hasib Qureshi. I'm a managing partner at Dragonfly Capital. We're a global crypto fund with offices in San Francisco and in Beijing. And so we kind of see DeFi playing out all over the world. We see deal flow from both hemispheres. And we invest very actively in the space. We're actually investors in Compound and in Maker, which is, I think a large part of what we'll be talking about today.
Great. Yeah, and Mia?
Hi, I'm Mia. I'm also with Dragonfly, and I spend most of my time here in China. And and previously I was at Amber Group, sort of coming from the CeFi world. So it's been interesting to observe how the two worlds are merging.
Great, and Mabel?
Great, thanks for having me here. I'm Mabel Zhang. I'm principal at Multicoin Capital. We are a thesis-driven investment firm based off our headquarters in Austin, but obviously we also have myself being in Beijing. We are glad to be here. We've been doing a lot of research in DeFi space, and we recently did one of our first primary investment into the space, which is DForce.
Speaking of DForce, Mingdao.
Hi everyone, this is Mingdao from DForce, and DForce is basically a DeFi's full metrics protocol startups, and we're actually working on asset protocols, trading protocol, and lending protocols. I'm very glad to be here today to join all the panelists and to share some of our observations in the DeFi's slants in China.
Yeah, great. And I am very happy to have you here. And for those that don't know me, I'm Celia. I work for the blog. I'm a reporter. And so I guess we really can kick off our conversations by talking about like really what everybody has been talking about in the past few weeks is really the launch of 2 governance tokens from Balancer and Compound, right? And Balancer basically announced that they're doing liquidity mining with their token June 1st. And when they start distributing the tokens, the price really shoot up at one point, and now is kind of calming down and going back a bit. And it really brings up the asset under management on that protocol. And for Compound, the same thing is happening. We see the price going up to, I think, $300, above 300 at one point, and really bring up, I think, the outstanding debt on that protocol jump for 400% at one point last week. And so there's a lot of tractions, a lot of attentions on these two tokens. But there's less clarities in terms of how people value those tokens, right? And so what do you think from like investors' perspective, from protocol developers' perspective, what do you think is behind this growth of this price of this token, and whether this growth can be sustained? Everybody's having this space. I'm just gonna pick a random person, I guess. Mabel, do you want to take a stab?
I think I was on mute, sorry. Yeah, happy to. I mean, I think like one trend that I did observe was that, a lot of people like to make this analogy comparing this hype to the ICO hype in 2017. However, I think there's like a big difference is that a lot of these investment funds, whoever have the capital and have the ability to do the bot trading, they're actually using a lot of algorithmic kind of help to do a lot of these liquidity mining. I think this is what also kind of increases. One is obviously like expedited the whole process of the whole thing being heated up, and the other thing is it made a lot of the retail harder to make money from this process. I guess like your question is also like general broadly how we comment on this space, right? Is this sustainable or not? I think like long-term heat up, it's probably not going to be like that sustainable. But I do think this is a great opportunity for a lot of these open finance protocol who did not really do a big round. Because like back in 2017, you have these ICO to distribute all these tokens around. But I think liquidity mining essentially it's more than just yield farming. It's also a great tool for people to get exposure to the like distribution of this DeFi tokens. So I think that's also like an interesting observation.
Great.
So actually, as an investor, I'm kind of loath to talk about price, but I will kind of talk about the dynamics around the token. So I think at a high level, it's very easy to get overwhelmed by what's going on and assume that there's some kind of crazy mania happening. But what's going on with Compound is actually, in principle, quite simple, right? The initial approach to what people were going to do with ICOs was that they were going to raise a lot of money, they were going to launch a token, launch a protocol, and then because they had so much money, they were going to use that money to build things that were going to make the protocol valuable. And that thesis has basically almost entirely turned out to be a bad thesis, right? Like you give some protocol a ton of money, you give Hashgraph, tons and tons of money, they can't pour that money into making the protocol more valuable, right? It's sort of like, it's like funding Magic Leap or one of these super overhyped technology companies that doesn't actually deliver a good product. So what's happening now with Compound is very different, right? So what Compound is saying, they're saying, look, we have a lot of value, but instead of you giving us a bunch of money and we promise you we'll build a project that's worth all the money you give us, instead what they're saying is we are actually going to subsidize the product. So it's kind of like, think of Uber or Lyft, right, or Didi. This is a situation where you've got rides, you've got drivers, and what you want to do is you want to pay them extra to make it more attractive for them to use your product. So in this case, Compound is subsidizing the borrowers and subsidizing the lenders. It's paying them extra. It's like a referral program. And that's what's attracting all this capital, right? That's what's attracting all this new usage. Now, it's a real serious question of, okay, when this subsidy ends, when you stop subsidizing your riders and your drivers, are they going to stick around? Are they still going to want to use your product? And that's a very real question that Compound needs to answer. And in some sense, its answer is, well, I'm going to keep the subsidy going for 4 years. And at the end of those 4 years, I'll get such a big network effect that people will still want to use me because I'll be the best place to lend and to borrow. As to whether that will be true 4 years from now, who knows? But what's happening at a fundamental level is just a subsidy. Now, right now, the subsidy is kind of weird. It's incentivizing weird behavior that doesn't really map very well onto what Compound wants to do. But governance is in the process of figuring that out. And I would guess that within a month or two, they'll probably iterate towards something that looks more like Compound incentivizing the right kind of economic activity, as opposed to incentivizing people to just get levered up like crazy and do weird things, which is what you're seeing today.
Yeah, it's interesting, Hasib, you mentioned, because the analogy with ride sharing and O2O. I was actually once a growth hacker at Mobike, which is one of the largest bike sharing companies in China, and we saw this subsidy, we call it war, like 补贴大战, right? Like played out in the traditional internet space, where you spray your users with vouchers and coupons, and then like they come onto your platform, but once you shut it off, like they just leave and then go to the other platform that's subsidizing them more. So it's a race to the bottom. So, but I think the difference here is that for Comp and this new wave of like subsidizing in DeFi is actually different, because it's less capital intensive on the company itself, and it's less transactional. So I think this is something that is worth digging into moving forward. And then how do we find that perfect like game theoretic equilibrium?
So to build on that a little bit, so I think one difference between this and the literal example I gave of Uber and Lyft or Didi subsidizing riders and drivers is that in Compound there's one subsidy paid out to one side of the market and one subsidy paid out to the other side of the market. And so what you should expect over time is that capital that is getting an interest rate that's worse than what is getting on Compound, that capital will come to Compound and that will drive down the interest rate. And over time, I mean, right now it's early and right now still a lot of people can't source their borrow from Compound, and Compound right now is still very, like Comp token is very volatile. So it's hard to actually tell day to day what is my interest rate. It depends on what comp is worth. But over time, that should settle down. And what you should see is that actually the interest rate on Compound will go down and down and down and down until it settles near the natural rate of interest, which is very different than what happens with like Mobike or with Uber, which basically keeps subsidizing everybody forever to keep the same incentive as long as they can. But that's not the way that the Compound distribution is going to work.
Yeah, that's really interesting. I think there are a lot to unpack here. And since we mentioned this kind of like parallel between what the governance token is doing and also what ICO is, it's almost like a reverse ICO, right? So I prove that I have tractions and then I issue a tokens and you guys would want that token. So from the protocol perspective, I would like to know how is this new way of raising, fundraising, so to speak, how is this new ways of issuing a token makes sense for the health of the protocol, also for this like to sustain the team. So I think Mindao definitely chip in here, and also Chao, who actually Maker, one of the first actually have a governance token, right? So definitely feel free to chip in.
Yeah, actually we have a governance token ourselves, DeFi token, but it's not mainly just for governance. I think just echo on some of the points Hasib and Mia and Mabel just made. I think we are very familiar with Compound, right? Our first protocol is basically based on Compound V1 code. I think the problem with the whole liquidity mining thing is that, and Hasib, you actually look at the balance sheet of the Compound now, it's totally distorted, right? A third of the capital is actually not stacked in BAT, which I don't think is some of the asset everyone prefer. And you look at the interest rate curve, I don't think Compound has the interest rate, the perfect interest rate curve before they actually do liquidity mining. When we launched our lending protocol back in last year, we have a better interest rate curve than Compound. That's why we can actually grow to like a third of Compound's lock value in a span of four months. And you look at Compound now, the balance sheet is so distorted that if you actually a depositor for USDC, you will not go to Compound, right? So you crowded out all the actual users. And for a borrower, you will not like to borrow USDT on Compound as well. So I think that's a very, very good experiment in terms of bootstrapping the liquidities in the platform. But I think that the question is still how much of that was stay. You look at USDT, they already, it already jumped like, I think it's fallen like 50 or 50-60% compared with the peak level. It's down to like 80 million. Being farming Compound day one, and farming Compound day one, the yield is very good. It's like 150%. It's very attractive, and I withdraw all my monies already because the yield is already finding its equilibrium where probably yesterday counted Compound's and interest rate is around 7-8%. It's not very, very attractive now. So I think the problem for Compound is that how can they really respond to this kind of distorted sort of incentive behaviors? And I think it's going to be a long-term issue. They have a lot of patch proposals. I've been very active on some of the forums and very good quality proposals coming out there. But I think it's a very difficult problem to solve. And I'm very, very skeptical of basically baking a marketing mechanism into the protocol, right? That's what I believe Compound probably should learn from that. Is it's basically just bake a marketing campaign, which are supposed to be short term, right? You can't bake a marketing campaign, like 4 years marketing campaign into a protocol. Is very, very difficult to change. I think that, you look at some of the good practices, I think synthetics definitely one of the very good one. They pioneer the liquidity mining in DeFi space, and they just chop their incentives into like 2 or 4 weeks or for 10 weeks. I think that's a better approach. And then we also will do our own liquidity mining in the future with some of the asset tokens we are launching. And there will be a very, very interesting interaction between our protocol and Compound and the other protocols. So yeah, I mean, from our perspective, we look at more from perspective how to design a really sort of aligned kind of engagement mechanism. So far, I think Compound still had to figure out a way to really have a long-term sort of aligned interest engagement with the platform. I think that's a huge problem, because if you don't have a interest rate curve that's really very, very catering to the markets, and the more incentive you pump into the system, it's going to be worse, right? Just distorted whole balance sheet. The situation will get worse because not your user will be using the platform. I think that's something I believe the Compound is facing now.
Sure. Before we unpack here, like the 4-year marketing campaign, high yield, posting potential danger, Chao, do you want to pitch in on the governance token aspects and how Maker is able to, like not run, but being the team behind the Maker ecosystem?
Sure. I think first of all, I think it's great to see Compound is willing to spend 1 billion into a marketing campaign, which also brought us more users to DeFi in general. Well, there are some positive externalities to other projects too, but like the positive one, there are some negative ones too. So I think people make analogies to the subsidies in the internet product. I think there's a big difference because if during the Didi and Uber price war, if you are whatever the size you are, if you are on Didi or Uber, the customer always benefit, right? And the drivers benefit, the passenger benefit. But take the example of Compound. If you are a farmer, that's good for you. But if you are a borrower on Compound or borrower on Aave, you were suffering from the past 2 weeks for the ridiculously high interest. So that's some immediate concern or negative impact I see. And for the long run, I think high yield often correlate with high risks. And for the secured lending in DeFi, the risk is in the collateral itself. So Mingdao mentioned the bad asset account for over 30%. So that's a risk. And also the asset itself is highly leveraged, which means that if there's a market crash of 20%, those assets cannot be liquidated properly. So there's both the liquidity risk and solvency risk right now. And I've seen there are some modifications through the government to fix this problem, but I don't think it's going to be enough. And there's a fundamental risk parameters now implemented in this secondary algo lending platform that is a asset-specific debt ceiling. So you don't allow those risks to spread, especially for the bad currency, to drive out the good ones. So that I think that's some risk isolation tool we really need into the DeFi space. And for Maker, so we just keep what we have been doing. We don't have a plan for this liquidity mining or farming or whatever you call it. We focus on our focus this year is on the real world asset to onboard more liquidity to the DeFi world. So that's been our focus. I think that's what brought the DeFi to the mainstream adoption.
Great. I think maybe Haseeb or Mia has something to say in response to Mingdao's comments on Compound. There is real worries here that, well, like we all know, this high yield cannot sustain. But really, where the tractions come from, is it from Bitcoin people because they got so bored of Bitcoin outside of crypto, or just like really DeFi people arbitraging out themselves?
Yeah, so look, I pretty much agree with most things that everybody has said here. And I think like the compound situation is very new. Everybody's talking out of their ass if they say they know what's going to happen, because this is uncharted territory for crypto, which is always a sign that we've stumbled onto something interesting, right? We're going to learn something either way. I think, you know, to call it a marketing campaign is, I think, a little bit, gives it a little bit short shrift. Like I remember talking with Robert about this months ago, and he was saying that like, look, we need to distribute tokens. We need to somehow we need to make this thing decentralized. And if there's one thing that Compound is almost certainly doing, is that by the end of this, Compound will be the one crypto protocol besides Bitcoin that is not VC owned, you know, that is primarily owned by regular people and presumably by its users, at least at one point in time. Now, that takes a long time to happen. And it's absolutely true that there's a lot of distortion that comes out of an extremely large and poorly targeted subsidy, which is what the comp distribution is right now. It's a very poorly targeted subsidy that's encouraging lots of weird, reckless behavior. I trust that governance is going to figure out how to create a sustainable subsidy that doesn't incentivize weird behavior. But you know, anybody who's been at, you know, Mia probably knows this, having been at Mobike, like, yes, bad subsidies encourage really weird behavior that doesn't look like what your target user is trying to do. But this is kind of part and parcel of figuring out how to create an effective, you know, marketing program or airdrop program. So the people who are, the real question is, today, yes, there are speculators who are going super long Compound, and they're not here to stay. They're just speculating, and they're tourists. And the moment that the subsidy goes down, they're going to go away and they're going to get replaced by somebody else. The real question is, are there new people who are now sourcing loans from Compound who previously would never consider using DeFi? And I know for certain that the answer for that is yes. We've talked to some people who are actually, you know, sort of mainstream lenders who are now saying, look, I'm going to source my capital from Compound now instead of from somewhere else because I can get better rates in DeFi than I previously could from my other sources of capital. That's something new. Now, are these people here to stay? It really depends on what the rates on Compound look like 3 months from now or 6 months from now. But the real big thing in my mind is that they've opened the door. That is the big thing that's not going to be closed again.
But this is a question. Sorry, can I jump in?
Oh yeah, totally. Open mic.
Right. So like I was actually trying to follow this logic, but like think about it. For people who, like, if they were to seek for low interest rate to borrow or like to lend or whatever, like they would have come in before that because the rate is actually better for them. Oh, you're talking about lender, right? I was thinking about borrower.
Yeah.
Still, like, I was trying to like think more about this analogy of subsidy versus like Compound giving this comp. I'm not sure if this is the completely right way to put it. Like exactly like what Chao's like mentioning. Like for example, I used to work at DD as well, and I was actually fighting with Meituan on a lot of these subsidy war. So one of the thing about the supply and demand curve for DD and Uber is that by subsidizing, you're actually educating people with the experience of a better way to go out. I guess like you're saying. And like Compound's doing the same thing, like by giving people like, you know, rewards and comp, like people figure out like this is actually a better experience, user experience to do it. But at the same time, like some of the people who would like originally borrow, like their experience will be hurt. I guess like this is the fundamental of the difference compared to the internet era, Web 2.0 type of subsidy. Another point I do agree that though is that you said earlier about the interest rate goes down. And I think that the fact that Aave and some of the other lending protocol that might come up later, because like they're actually not giving out this subsidy. Maybe for people who actually want you know, lower rate of borrowing, they will go there, and this would actually come back and push back down the rate for Compound. So I feel like this might actually not take forever to, like, it may not take long for people to really come down because you do have competitors in the space.
Exactly. These are all open protocols, right? So if something is mispriced on one protocol, then it should be sort of, you know, essentially arbitrage back, not arbitrage per se, but, you know, people should renormalize where they're borrowing from and where they're lending to until everything sort of returns to the natural rate of interest. Obviously, in the short run, look, if there's a DeFi mania and everybody's trying to get comp token and all these memes are going around, and yes, things are going to be kind of crazy for a while, but they will settle down. And when they do, I think things are just going to look a little bit more pedestrian. Compound is just going to be bigger than it was before, but it's going to have a pretty normal looking interest rate once they figure out how to normalize these markets.
Great.
Yeah.
Sorry, Mingdao, do you
Yeah,
have any?
I think there is an echo on some of the point that has been made about the distribute your token to the users. But I mean, from my own experiences, I'm farming very heavily on Compound. I think I know people contribute a lot of capital to Compound, but those people are just arbitrageurs. They just, well, at least for me, I sell Compound every 5-6 hours every day. Because the yield is very easy to calculate. You know, your ROIs, you just sell it. I know most of the farmers in the market just doing the same strategy. They don't really. So I mean, my question is really, if actually the whole liquidity mining thing is just a arbitrage game. At the end of the day, there will be no actual users, right? I don't know who is going to own the token, because the users is not going to own the token, because all these farmers are not actual users. It's like arbitrageurs like us, traders like us. And you look at the distribution today, they account for 95% of common use today, right? And USDT used to be like 95%. Now it actually rotated drops to BAT. So, I mean, it basically just providing all this liquidity or profit to the BAT wealth. So I don't think they actually use this. And how, I mean, from our perspective, I think that we really.
Minda, I think we lost you.
Yeah, I think I think we got the questions, right? So would comp or other governance token get into the hands of actual users versus arbitrageurs?
So I think he makes a very good point, and that's absolutely correct. Like I granted this point, I think earlier, that right now things are super distorted. And while things are distorted, you know, it's kind of like any time that you have a way to literally make money inside your own product, you're going to incentivize a lot of weird behavior, you know? So this kind of thing, I mean, you know, I used to work at anti-fraud at Airbnb, and we would see things like this all the time because we'd have, you know, referral bonuses, right? So somebody could refer themselves, or somebody could have a, you know, some way that they could book a listing that was fake and then pay themselves, right? Anytime that you have a way to make money in a system like this, you're going to attract people who are just there to abuse the system. And that's what's happening in Compound right now. And that's fine. Totally agree that that's happening. That's where most of the comp is getting distributed. So it's on comp to fix that, make sure that it's not really possible to, you know, primarily make money by liquidity mining and distorting these markets, but that the primary way that this issuance happens is more in line with the natural rate of interest across different protocols. Once they figure that out, and I don't believe that's an impossible problem, that's something they can do, then it will look more like it's going to users. But look, I mean, Mingdao said himself, like, he's mining comp. The moment that he's mining it, he's selling it, right? Someone's buying comp on the other side. So who's buying that comp, and what are they doing with it, right? Like, comp is not doing anything to buoy the price. If anything, they're doing stuff to push down the price by constantly minting comp to these miners who are selling it. So somebody out there, I don't know who, but somebody out there really wants that comp, and they're willing to pay a lot of money for it because they want ownership of this protocol.
Yeah, I mean, based on my observation, right now it's the Mingdao like type user persona is like, you know, the very like power users of DeFi. Whereas now we're seeing comp getting listed on like OKX and Binance and all these wallets. Like, those people who are getting comp, they're not DeFi power users. They're just like getting comp for the sake of getting a really good performing token. So I think right now the interfacing between the dynamics between these distribution channels and the protocol itself is very singular. It's very like, it's not like deep enough. Like, I think there's more room to pave the path for a deeper integration to like actually integrate Compound on these like CeFi platforms for users to have easier experience and offer it as either, you know, a flexible loans or something for, you know, OKX to have a easier like regulatory like, you know, hurdle when it comes to like lending markets and things like that. So that will actually effectively translate the top of funnel into like, you know, user conversion.
Great. I think we just have Mindao back. I think others just try to answer your questions. We record this whole conversation, so definitely feel free to go back and listen to their answers. So I think the other aspects to it, we touched upon it a bit, right? Remember, there's also a balancer getting no love here in this conversation, but they said while they're doing liquidity mining, I think there's a difference between Compound and balancer is that Balancer is actually doing liquidity mining. Compound has the effects of liquidity mining, but actually having a use case, people vote on it. It was the vote that decided that they're going to distribute the Comp token. So, speaking of liquidity mining, bringing the China aspect here, maybe more so for Chinese users than for English-speaking users. It really have a bad, recall the bad memories of AppCoin, right? So in 2008, AppCoin was a SemFi exchange, achieved great success at the beginning by giving out rebate basically in AppCoin, but then it quickly went down. So what is really the difference here between a project, say like Balancer doing liquidity mining and AppCoin? Beside the obvious difference that one is SemFi, one is DeFi. Chao, do you want to take a stab?
Well, I didn't follow Balancer either the AFCON very closely, but I think there's no fundamental differences here. It's just I think the important thing is just to make your protocol secure enough. I mean, before you bootstrap your users, you need to make it secure. I think both of them are suffering this security problem first. Fcoin failed. I think most of the reason it's not because they didn't design the system well. I think they have some bugs in their design, and they lost a lot of fund. And some similar thing that happened to Balancer. I think that's the thing. Because launching a DeFi product it's not like launching a software. It's like launching a rocket. There's no way back unless you are very lucky to get your money back. So that's my take.
I think I disagree a little bit on that point. Even though I also make the analogy that Fcoin and Balancer or liquidity mining is similar, but I think they're different in quite a big way. One is I also been trading and mining Fcoin at very, very early stage, and then I stopped for about a week, actually before they started, because the price is crashing and you really cannot make a lot of arbitrage from this. I think the big difference is that for Fcoin, is a totally centralized black box, right? You don't know what is going on there. And for Balancer or Compound, it's very transparent. It's on chain. Everything's on chain. You know the risk of liquidity mining. And there's also a very big difference. Is because Balancer is basically an AMM, it's automatic market maker. Where the liquidity pool itself is a big advantage. So I think Balancer is really, I think they're very smart because for a Uniswap type of reserve protocol, the deeper the liquidity, the better the price and slippage. The lower the slippage. This is a huge competitive advantage comparing with for example, like Uniswap. So if you actually can maintain a very, very deep liquidity force, you will have a very great advantage compared with the other AMMs. But for Fcoin is different because the liquidity itself doesn't really bring a lot of advantage to Fcoin. People just making profits. But so I think that these are two fundamental differences. But I think we're talking about Balancer, Compound, and the way we look at it. I think there was also one of the challenge is that for Balancer just for tradings and the incomes and all the profits for just trading fees, and for Compounds was interest rates. We look at it, or defaults look at it, is that we got to create a protocol that really connect lending and trading. So you have two sources of incomes that you're able to retain liquidity. Otherwise, it's very, very easy for liquidity to just leak out from the ecosystem. So I think that, I believe in the future, vertical protocol is very, very difficult to capture that. It's not going to be able to capture that because for Compound, if actually you have a a protocol where you can also capture the trading volume, trading value, you will definitely go there because your ROI will be higher than just in a lending protocol or in a trading protocol. I think that's something that probably banks or compound will face over the next year when a lot of competitors like us, we do a lot of aggregation. We will aggregate on the trading level, aggregate on the asset level and lending level, where we have provided better yield for the users. I think these are some of the competitive landscape that we're seeing that will be evolved in the next one or 2 years. Vertical play will be very, very difficult to compete in the markets. There will be aggregators, and we're doing aggregation as well. So that's also a very interesting trend in the DeFi. So how the vertical things playing out like Curve 5, doing stable swaps, balance such as the tradings and counters to lendings, or we maybe have a giant cluster of protocol matrix where we can capture the profit or the value in each of these protocols. I think that's going to be a big trend.
So I kind of want to say that, so one, I think Fcoin and Balancer are very, very different. So I have to echo Mindao here. And that, you know, when you think of like what Fcoin was incentivizing, Fcoin really incentivized lots and lots of wash trading. And that was the primary way that people got exposure to mining Fcoin. It didn't actually make Fcoin that much better of an exchange. It did make a lot of people want to mine Fcoin, but it didn't mean that, you know, Fcoin was the most liquid place in the world in order to get, you know, some orders of crypto filled. So it's a perfect example, I think, of what's called Goodhart's law. And Goodhart's law is this idea that whatever it is that you measure will end up becoming a bad metric. Because if that's what you're rewarding people on, then that's exactly what people are going to try to gain. So if you say that I'm going to reward volume, people are going to wash trade because that's volume and it's the easiest way to get volume, right? And so what Balancer is doing is they're finding, I think, what's actually a pretty good metric, right? It's pretty hard to fake. Look, if you provide liquidity, we'll reward you. And you know, you can obviously put your money into really dumb Balancer pools, which is what happened with their most recent hack, or you know, hack, attack, whatever you want to call it. But at the end of the day, I think I could totally agree with Mindao here that Balancer is just rewarding liquidity, and liquidity is exactly the thing that matters in Balancer. It's the only thing that matters. So that 100% works, right? Same thing. If Uniswap did the same thing, it would 100% work. The problem is that Compound is a little bit more complicated, and the subsidy is so big that it's throwing things out of whack. Now, if they can fix that, and they can subsidize the right activity the way that Balancer is subsidizing the right activity, then it will be awesome, and we'll have much less to complain about compared to what we're complaining about today. I think that they can get there, but obviously other people disagree.
I think it's interesting that you said like it's a little bit complicated for Compound. I was trying to think from, you know, the retail's perspective, like, you know, whether it's more obvious for them to like mine Com versus mine Balancer. It turns out that actually for ROI on Balancer is obviously harder for someone as a liquidity provider to calculate, but for Compound it's much easier because you actually, even if you do like multiple rounds, like, you know, you lend out USDT and borrow USDC, whatever, you still can calculate that very straightforwardly. So I feel like, you know, a nuance add I would have here is that in addition to what you were saying, another layer is that for Balancer, it would require, like, it would incentivize people who have better or more sophisticated knowledge to provide liquidity. Because like that way, people are actually understanding what they're doing. A lot of the retail I spoke to actually, because they can't really calculate how much they're making on Balancer, they chose not to do so. Because Compound for them is much more straightforward. So I thought that was pretty interesting nuance.
Yeah, to be clear, I didn't mean to imply that Balancer is easy to use or that it's obvious how to calculate the returns. My point is simply that the subsidy that Balancer is giving is super simple. It's just give us liquidity and we'll pay you. And there's, you know, how can you game that? You can either provide liquidity or not. And if you choose not to, I mean, obviously you can choose what pool to provide liquidity to, and some are easier than others or some are more attractive than others. But that's all that I meant. I totally agree with you that like taking a position on Balancer is a very complicated thesis, right? You're betting that these 5 assets are not going to change very much in price relative to each other, and you know this pool is going to accrue enough fees plus my BAL airdrop, right? That's complicated. How do you value that? You kind of have to take a rough guess. But the incentives are a lot more straightforward with the Balancer distribution.
Yeah, I do want to bring the China aspects into this. So we kind of touch upon it, right? So what would be like Chinese DeFi user profiles in this giant hype cycle, right? Like, what do they care about more? Is there anything that is different that they care about than some of our English-speaking users? Do they go in more for the arbitrage opportunities, or do they really care about, say, the ecosystem? Like, what is really, if you were to draw that kind of persona, what would be some of the attributes that you would give to this person?
I feel like Mindao will have the best understanding of this one.
Yeah,
I think people
answer.
are really I think people are really jumping into this DeFi hype recently. I think there are actually two parts. One is on the farming thing. I know a lot of people do a lot of farmings. I know in person at least people with like $30 million supply the compound for farming in the first 2 weeks of the exercise. And those people actually don't play DeFi. I mean, so that's an echo on Hasib's point that it indeed bring a lot of people into the space, and they just forget everything about the vanity hacks, right? They forget about the security risk and everything, just jumping in and farm the yields. So it's very fascinating to see how people are actually so brave to actually put a large check of money into farming. But actually, from a regular user perspective, I think that the Chinese users are really less cares about ideology or governance or decentralized governance. What they care more is about liquidity, about price, about user experiences, and that's also our experience as well. We actually talk to all the Chinese users or the DeFi users in China. They do play a lot of these DeFi protocols, but mainly the major one they use are some of those that offer the best price and liquidity, and they typically don't have some fancy ideas, right? So there's a lot of fancy DeFi protocols, but it's difficult to gain much traction in China because. And the other thing about the competition landscape is that you look at the DeFi operators like exchange or DeFi lending platforms in China. They are catching up very fast. Like Binance already have their current accounts, current saving accounts. Basically, your US dollar, USDT deposit into Binance, you'll be able to earn a real-time interest. It's very similar to DeFi's like Compound provided. So I think that it's very innovative in terms of the DeFi operators. So they are very aggressive in terms of offering the products, and that's also one of the reasons that the user profiles in China and why Chinese users not really catching up in terms of adoptions and use a lot of DeFi products, because 80% of those users are already being served by the DeFi chain, and they are hugely innovative. You look at the competition of the second-tier exchange in China; they offer futures, IOUs, and perpetual swaps and comms much earlier than for example at Binance. So that's a very interesting sort of user profiles comparing with the West, where in US, for example, some of the hardcore users, but in China, it really are some of the users that I think most of them are served by the CFIs already. So only those DeFi protocols really have very attractive prices and liquidity is able to attract the users to use the protocol. Yeah, but I think that there's one thing is the wallets and all these applications already integrated DeFi. So I think that those are a very good sort of strategies to integrate with DeFi protocol. It's very easy to use now for some of the like Compound or MakerDAO on some of the wallets. I think the user base is growing. We have the most active DeFi communities in China, and we see that people are really have a very strong interest, not just because of comp hype, but because that actually there are a lot of products that are very useful now.
Great. I also like, Chow, if you want to pitch in, definitely would love to hear. And I think one of the questions that people might have in terms of Maker and DAI is really its positions, how it positioned itself versus USDT in China, right? So would love to hear your thoughts on that.
Sure. So I don't view USDT as a competitor, or at least in the short term, because we're running on a different models. Tether is like the suboptimal equilibrium here in this market. So people, there is a better choice, but people lack of incentive to move on to that options. I mean, simultaneously. What Maker is doing is positioning ourselves as a credit issuers. So I think the first thing you want to to do a DeFi product in China, first you need to figure out your product market fit. And China is a very interesting market in terms of in terms of crypto. And if you put it into a macroeconomic perspective, so China is basically supplying the capital to the world. They are the biggest mining pool from China, the biggest Bitcoin, Ethereum investor from China, and in contrasting, the U.S., the European, they are consuming those products. They build upon those kind of payment system, etc. So take that into Maker. So there are lots of ETH holders. So they are providing the capital. They are the supplier of the DAI, and that's why we have China as the second largest user base. And on the other hand, there is also a kind of domestic demand for offshore dollar market. Those people, for regulatory reasons, those people who want to have exposure of dollar, but they don't have the access or enough access to it. So they use that as a medium of change also of value. I think the first thing you need to think about, not only what are the value you bring to the users, but also what are the value the user can bring to the protocol in a macro level. I think the second thing to do, I think for any Western project that come to China, is finding the right partner. So unlike the users in the West, they are primarily on the desktop, and the way they interact with the DeFi through probably through the MetaMask. Here, the wallet is a big deal. So because most people are on their cell phones, and the great thing about wallet is that they have more advanced data and they have a deeper connection with their users, unlike a simple blockchain address, which doesn't tell many story of it. So I think doing co-marketing campaign with the wallet and have a very native user-friendly integration is very important. I think last is the localization. I think it's something people know they need to do, but they didn't do very well in reality, because it's not only about getting a white paper translated in Chinese, but also have a speed optimized and have a local support team. Support team is very important. I don't think many, this is not only to DeFi blockchain product, but also internet product in general. China market is very operational heavy. You need to have people answering those very basic questions. They don't want to spend time reading your long FAQ, etc. You need to people can educate them and guide them through the process.
Yeah, which is why we're partnering with Chain News for this.
Right, exactly.
Right.
Find the right partner. That's key.
Yeah, so I know that we have more to say about this China user profile, but then I do want to address, as we have 10 minutes left, and really the elephant in the room question, because Balancer just got attacked, right, 2 days ago or 3 days ago, and you know, like I know that if there's one thing that Chinese users, US users care about, like collectively, is really the security of their investments on those protocols. And I actually received a bunch of questions actually ahead of time asking about security of the protocols. You know, like it's an interesting question, because the dynamics of a security is you can't have a protocol that is like absolutely like 100% secure. It's about like your risk model. Is it basically like a delicate dynamic between your risk model and how secure your protocol be, how much money your attackers have to like attack you, right? So, you know, I guess from the protocol perspective, what can you do to inform users the risks on the protocols, especially given that a lot of Chinese users probably don't even read English or don't have time to go through the Q&As, protocols. What can protocols do better to make sure that they understand the risks? And and then a lot of times to avoid legal troubles afterwards, right? People are going to sue you even though you say, hey, we're decentralized, we can't sue us, right? So
yeah, I think security in DeFi is absolutely difficult. I always said that after the Leonard we I said that you are only as secure as your next hacks. So there's no way you can. I don't think that the DeFi in current form can solve the problem, and especially the composability risk, where some of the for example, the NFMe hacks basically is happening. Two of the protocols are already fully audited, but still some of the composability risk introduced because we onboard a ERC-777 token. So I think especially for the Chinese users, they are not really that kind of pay attention to the protocol risk. That's why I'm saying that people just jumping in compound, they're just mining on balancer without really care about the risk involving those protocols. And I think I have a little some lessons learned from this. One is that for the protocol operators, of course, we have to be very cautious on boarding new assets and doing all these things. But I think the audit, security audit is definitely not sufficient. Especially given some of the risks actually introduced by the asset protocol, which is without control of the functioning protocol, like lending protocol attacks. And one of the reflection I have is having a token, having a platform token is actually the only way that you can hedge the risk. For example, if for example, you look at Black Thursday, Maker incurred $8 million bad debt because of the Oracle malfunction. They managed to auction NKR and recap the system. So I think that having a platform token or utility token or governance token is definitely a competitive advantage for a DeFi protocol, right? So if you actually want to deposit money into a protocol, you have to think about who has the largest market cap, and that's a huge sort of a reflection point for myself, because people actually coming from the ICO bubbles, and we often question the rationale of having a token, but I think in DeFi, that's a very, very strong rationale of having a token. It's basically a last resort for you to recap the system, to tokenize debts or tokenize some of the losses in a hacked event. I think that's something that that's why we also have our own platform token. And those tokens will be the last result to absorb the risk in any hacks or any blow up in the protocol. And trust me, it's inevitable. Even the compound, yeah, it's trying rough for a long time, but who knows? The DeFi thing is so new, and there are so many attack vectors that can come up from anywhere. Yeah.
I do want to hear from our investors here, investing in those projects. How to assess the risks.
I can share. Oh, sorry, Mabel, you go ahead.
No, you go ahead. I was going to say more about the risk, like, after the hack, but like, what's the feedback? Well, you can go first.
I've been talking a lot, so you go ahead.
Well, it's not about controlling the risk. So one observation. Sorry, I was muting myself. So one observation I had, I think a lot of us will agree, is that in China, people would take this like DeFi protocol more as a product than being ideological than in the US or some of the other places. So then like people, when the hack happened, what people's reaction immediately was like, oh, in the future, should we add a circuit break, for example? Like, should we kind of cap the maximum withdrawal within an hour or whatever to 10% of the total pool, for example, for one asset? This could be, and I'm not saying like I'm fully buying in the theory here, but I think, the fact that these discussions are popping up already shows that, I think, in China specifically, a lot of people are taking DeFi more as a product, and then adding these potentially interesting key lock can maybe add a bit of security, because like we all know, like the robust part about DeFi is that this global liquidity, like capital can flow anywhere. Like, let's say if you're in compound, rate goes up, you could just go to Aave without any like problem barrier. But then like at the same time, like you'll also have to think about like whoever is like, you know, being like using this product. If it's retail, it's a small amount, maybe it's fine. But what if it's like a large CeFi that's being being capitalized by these DeFi protocol? Because I think a lot of people who are working in DeFi, like they had their ultimate ideal kind of situation is like, you know, use DeFi protocol to finance the CeFi institutions, just like what Mia was saying. But I think this will be hard without any like intervention. I'm just being pretty practical here. I think a lot of people might not disagree, might not agree with me in the West, but I think this is like a trending thing discussion people are having here.
So I want to offer just like a little bit different perspective. So sort of zooming out a bit, right? Like I think there are basically two classes of DeFi protocols you could say there are today. There are, you know, everything in DeFi is supposed to be open, meaning you can see everything going on chain, anybody can interact with it. But the way that these protocols are governed and taken care of are actually quite different. So on the one side, there's the balancers and there's the Uniswaps, which are completely permissionless, meaning that anybody is free to create whatever pool they want. And it's very much caveat emptor, right? It's very much buyer beware. If you're interacting with this protocol, you had better done the homework, you had better looked at these assets and made sure that they're safe. And of course, you know, even before the Lendef attack, there was a Uniswap pool that had IMBTC that had the exact same attack against it. And in the same way, we saw this balancer attack where there was this deflationary token, and Balancer said on their documentation, don't use a deflationary token, it's going to produce weird things and we can't account for whether it's going to go well. And that resulted in LPs getting hurt. And of course, if you weren't in that pool, if you were in a different pool, you were fine. So this is one model. And I think this model we've seen enough damage happen here that I think it's going to some degree erode trust in this model. And then the second model is more the walled garden model. So this is like the compound, the maker, where yes, it's decentralized. Yes, anybody can see what's going on, but it's not anybody can add a market, anybody can create a new product. There's one product, or there's one controlled set of products. A very informed and intelligent group of people very carefully vetted everything in that product. And there is some rubber stamp of saying, this thing is supposed to be safe. If it's not safe, we messed up, right? I think we're going to see more and more of the new innovation in DeFi look more like the second model than like the first model. And that's, I think, some of the way that DeFi is going to respond to these hacks and these attacks. But it's not going to be by, you know, closing off these protocols and sort of, you know, putting a padlock on them. It's going to be more that there's more care and more effort put into how these protocols are sort of grown from the ground in the first place.
Just want to clarify one thing, is that Maker is also fully permissionless. Everyone can propose a proposal and ride through the MKR governance process. We don't have admin keys. So
to be clear, I'm not saying that you have admin keys. Yeah, I'm saying that like not anybody can just like create a new collateral type and deposit it and see what happens.
Yeah, there's
I think one of the risks that, you know, I know that Maker and Compound, they have governance process investing different assets, but I think the difficult thing about composability is that it's interoperable with different layers, right? For example, WBTC is not a collateral on Compound yet, right? It's not a collateral on Compound, but WBTC is a collateral in a MakerDAO protocol. So basically, if there's an attack on the WBTC side where the outstanding are inflated, people are able to mint all the DAI and then deposit the DAI back into Compound and drain all the liquidity in the pool. So I mean, the problem is so difficult because of all this composability risk. It's really difficult to understand the edge of the risk. So I mean, Compound, even though that it disabled WBTC as collateral, but it's still exposed to WBTC a Minky hack risk because they can route it through DAI and then come back to Compound again and drain your liquidity.
Yeah, so I think we're a bit over time, but definitely any last words on any of the things that we said?
It's still very difficult. Yeah.
All right, I was literally about to end this. Well, I'm glad that we ended on a good note. So any last words on any of the things that we talk about? Mia, Mabel, Chao, Hasib, Mingdao, definitely feel free. We didn't have time to take questions, but we definitely can continue these discussions on Telegram groups, Twitter, and yeah, any final words? No? Okay, cool. And well, definitely thanks again for joining me. Really the blog's first APAC webinar series and the first webinars of that series. It was fun, right? And people, as expected, had like some good controversial conversations. Thanks again for joining me, and hope that we can meet up in real life at some point soon.
Thanks, Celia.
Thanks.
This was awesome.
Yeah.
Thank you for having us.
Bye. Thank you.
See you
Be
guys.
safe and healthy, everyone.
Okay, thank you. Thank you. Thank you.